Listen to AM 560 The Answer online at 560theanswer.com, on the AM 560 mobile app, on your Alexa-powered smart speaker, and on TuneIn, iHeart, and on Odyssey. America First with Sebastian Gorka, today at 3, right before Sean Thompson at 4 on AM 560. The Answer.
Top of the morning, Dan and Amy. So, Chairman of the mystical Fed Board, Jay Powell, yesterday announcing the expected 25 basis point interest rate hike. And as expected, because the market expected it, there was a rally and a good January in the markets. And so the soft landing is afoot, right? Is it? Jay Powell, in his presser after the announcement, fielded some questions from reporters, including one about the debt ceiling and its the need to raise it. Here's what he said.
I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner.
Is he right? To help us with that question and others, please be joined by the Capitalist Pig. He is Jonathan Hoenig, founding member of the Capitalist Pig Hedge Fund and Fox News contributor, author of a new textbook of Americanism, The Politics of Ayn Rand. Jonathan Hoenig, thanks for joining us. Appreciate it.
Great to be with you, Mike and Amy. I mean, look,
I'm Dan. I'm Dan. I'm not Mike.
Oh, Dan, excuse me.
You're on the wrong show. All right, let's get the
Mike
other.
Scott does the news.
Oh,
so that's...
well, all right. Mike, you want to take? I'm kidding.
The market is confusing enough as it is to begin with, but when Jay Powell starts talking and politics starts getting involved with it, I mean, maybe that's why I'm so messed up this morning. Is that there's so many shifting winds in today's economy, Dan and Amy, that I think it's more difficult now to be an investor, and given the inflation, it's more expensive to be an American.
Well, his like debt ceiling is sort of the Congress has to manage the fiscal side of the house. I mean, I sort of get that, although I don't know why he needs to take a position other than the obvious one that America needs to abide its obligations, though the theater around the debt ceiling raise, given the Treasury borrowing $250 billion more than originally anticipated, rings a little hollow to me.
Yeah, well, we're going to pay. The U.S. is not going to default. And, Dan, as I know you guys have discussed, I mean, this is a bit of a kabuki theater that has gone on maybe 20-some-odd times since 1980. The U.S. will not default. But what's going to happen is that, as we know, there's no free lunch. So all this prolific spending, all this debt will be paid for. And in fact, how we're increasingly seeing, kind of fact, what Wall Street alluded to is that we're going to see through a depreciation in the dollar. We've already seen inflation when the U.S. dollar has been strong globally. What we've seen, Dan and Amy, is the more this debt ceiling fight has gone on, the U.S. dollar is now starting to drop actually rather precipitously in the last couple of months. So, Americans are paying for it. They're paying for it through a lower quality of life. I know you've seen the studies that even Americans making six figures now are reportedly living hand to mouth. Orange juice, $6 a gallon. I mean, despite what the Fed says, this is a very difficult time to be an American.
Eggs are $6 if you can even find them. I mean, every time I go to the grocery store, which I have to 2 times a week, I get heart palpitations because everybody wants to know when is this going to end. And also gas too. This gas back is up almost over $4 in Chicago again.
Yeah, I mean, Amy, I think you're right. That's the thing. We'd like to think that inflation is the analogy was made early on. It's not toothpaste one can simply stick back in the bottle. And while it has come down, in terms of the big headline number from 7 to 6, well, 6 is still outpacing inflation, and 6 is still where it was in the early 1970s. Again, look at history, Dan and Amy. Inflation wasn't like it just ran rampant all throughout the 1970s. It had a peak, then a trough, then came roaring back. So, until it's the spending that's addressed, and maybe this is what the Fed was trying to allude to, what Powell was trying to allude, until the government stops spending, I just don't think this inflation genie is back in the bottle just yet.
Well, I was going to put all my money in orange and egg futures, but now I'm thinking, you're saying we have to buy toothpaste by the bottle rather than the tube, so maybe I should go long on toothpaste. So a question for you, though. Our friend Jim Perry over at Perry Capital said Powell made a mistake yesterday. He should have raised rates by 50 basis points, number one. But even if he didn't do that, number two, he should have been more hawkish than he was in his rhetoric about the hike. Instead, he was more dovish, saying, financial conditions have tightened, when Perry argues they've actually eased, and so there is more work to do, maybe more work than what the market is anticipating, which is another 25 basis point hike in March. What do you think?
It's so funny. It's like, what should the Fed have said and how should you said it? I mean, Dan, if I wanted to go in that business, I would have gone into the theater. I'm analyzing trends, and that's what's so frustrating is, again, we're trying to look at the markets, and yet so much of the market is dictated by the Federal Reserve. What's interesting is, rates were raising long before the Federal Reserve started raising them. And in recent weeks and recent months, it actually started coming down even as the Fed has continued to raise them. So, what should the Fed have done? Well, Dan and Amy, central planners are always wrong. They didn't see this inflation coming at all, so I don't trust what they're saying. I'm putting my money now. I think you have to be playing it relatively safe. There was a huge bull market in the early 1970s. In a massive bull market, just a bear market just 2 years later. So I think you can put money to work despite the Fed and despite the inflation, but I think you have to be very short-term oriented and very much focused on those off-the-radar ideas. Even the Facebook folks, down 60% last year, but up 20% just this morning on an earnings beat. So lots of volatility, but also lots of places to make money, unorthodox ideas.
So if the Fed holds as predicted, and starts to chill out after getting the Fed funds rate to 5% next month, then what do you see short-term for the markets? Are we going to continue to see the kind of rally that we saw in January?
Putting out bespoke investment that does some great statistical work, analytical work. Basically, Dan and Amy, when the market goes up the extent that it did in January, after the previous size losses the previous year, that's happened 5 times since 1950. All 5 times, the market's been positive the next year, anywhere between 15 and 35%. So history is on our side, despite Biden, despite the spending. History is on our side to have somewhat of a bounce back just this year. But I think, given the tenuous nature of most people's finances, I think caution is warranted, Dan and Amy. As I said, there's been other studies that said once inflation's above 5%, it tends to stay above 5% for at least a decade or more. So, until I see some real spending cuts in Washington, I think you have to be at least a little bit conservative with your portfolios. And, Dan and Amy, this is not a commercial, but one of the best performing assets this year so far has been gold, which has been a real hedge against inflation and a hedge against the dollar recently. So spread it around this year. Don't take big chances. I don't think we're out of the woods just yet.
Where are you on crypto? Bitcoin had a big bounce back, like a 40% bounce back in January. Meanwhile, Charlie Munger, of the famed Berkshire Hathaway, Charlie Munger with Warren Buffett, said that the U.S. should follow the lead of the Chinese communists and ban cryptocurrencies because they're not a currency, they're not a commodity, they're just a gambling contract, and they're not productive.
Well, maybe that's why we shouldn't ban them, right? Because as Munger has alluded to, they're not terribly productive. And interestingly, Dan and Amy, most people who purchase crypto, according to the studies I've seen, have lost money in crypto. I think that's the real issue facing cryptocurrency. What exactly is it for besides holding it as a complete speculation? Especially now, keep in mind, crypto really came of age when banks were paying 0 or negative interest rates during the pandemic. People were handed checks and told, go invest. At this point, I think a lot of investors are wondering what exactly is the purpose of investing my money in crypto when I can put it in other assets that perhaps are more safe, more long-term oriented. So, Dan and Amy, I'm not a crypto hater, but I think like any speculation, you just want to be conscious of what percentage of your portfolio, what percentage of your assets you're allocating to such an idea. So I'm not a hater, but I think you have to be really careful with, given the volatility we've seen both on the way down and even recently on the way up.
I don't know if you have any money left. I know you were long on Taylor Swift tickets, but there's an event happening in D.C. featuring Comrade Bernie Sanders entitled "It's Okay to Be Angry About Capitalism."
Really?
That's the event. You can buy tickets via Ticketmaster.
Oh,
interesting.
Wow.
Are
we going?
That are between $35 and $95. So for Bernie, a college should be free, but you have to pay to attend him railing against capitalism.
They have to be all the socialists have to be hypocrites. If they really were from each according to his need to each according to ability, they would be living out in a tent with absolutely nothing. Bernie somehow finds time for the houses and the chauffeurs and everything else. Of course, he enjoys. It's always Animal Farm with these guys, right? Dan and Amy. It's like the rules are for everyone else. It applies to them, but not to thee. And what's so frustrating, just as an American, is you look around and see everything wonderful we enjoy was created by capitalism, created by individuals thinking, employing, producing all the technological advancements, all the advancements in health and nutrition and all the rest. So, we live as Americans, our middle class is considered wealthy on the world stage. You'd rather be a middle class American than a wealthy European by many standards. So we have it extraordinarily good, not thanks to communists like Bernie, but thanks to Americans, some of the great business tycoons of our age and of ages prior. So I'm thankful to them and thankful certainly to the free speech that lets us speak out about it, unlike in so many of those communist and socialist countries that Bernie seems to love.
One other contraindicator, just on terms of Fed policy, the belief was you needed to start see layoffs tick up, and you're seeing them in certain sectors and certain businesses in order to indicate that the policy is working and they can start to relax the rate hikes. But we have news out yesterday that job openings in the United States increased to a 5-month high. So the labor market's still pretty tight. And how does the Fed interpret that with respect to using that as a bellwether for their policy on rates?
I think you have to take a longer-term perspective than just one report to the next. There's an old saying on the street, Dan and Amy, one swallow does not make a summer. So I think we're in the winter now, both literally and metaphorically, when it comes to the economy. And one good report necessarily, I just don't think changes this dramatic trend we've seen of massive layoffs. And, Dan, they're not just into the small companies, and technology led us on the way up. I think they're unfortunately leading us on the way down. And, I'm still a relative, despite the fact the economy has bounced, what we've seen is that the stocks have bounced the most in the companies that have cut the most. What we see is this phenomenon these days of what's seemingly good on Wall Street is what's bad for Main Street. So companies are getting rewarded for laying people off right now. So I think it's unfortunately a bigger picture. Might be a good omen for Wall Street short term, but I think it's a pretty worrisome omen that the companies that are doing well are not the ones that are investing, but the ones that are letting people go.
He is the Capitalist Pig, Jonathan Hoenig, founding member of the Capitalist Pig Hedge Fund and Fox News contributor, author of a new textbook of Americanism, The Politics of Ayn Rand. Jonathan, thanks as always.
Great to be with you both.
Thank you, and he joined us on our turnkey.pro answer line.
Listen to Dan and Amy on your smartphone. Download the AM560 mobile app today at 560theanswer.com/mobile.
First, we decide where we want to go. Then we need to know the best way to get there. Hi, my name's Adam Barada. I'm the owner of Advantage Gold. We're the highest rated precious metals firm in the country. We teach people how to own physical gold and silver. Now, we've won the Best of TrustLink Award 4 years in a row because we educate our clients on how to buy gold and silver the right way. We don't pay celebrity spokespeople millions of dollars. We'd rather pass that value on to you. Call 800-900-8000 and speak with one of our experts. We'll send you a free gold kit along with my latest #1 national best-selling book, The Great Devaluation. Call 800-900-8000. That's 800-900-8000. Get the best information, the best process, the best service, the best value. Call it.